You were sold a product and told it was a plan. That single sentence is why I'm making this video. If you have between $2 and $5 million saved, and someone in the last 5 years walked you through a colorful brochure, showed you this pretty chart with guaranteed income, and handed you a stack of paperwork the size of a small novel, there's a very good chance what you actually bought is just a variable annuity with a living benefit rider. And there's an equally good chance no one has ever explained to you what that product is actually costing you in real dollars and cents, or what it's not doing that a real plan would. I've watched engineers, physicians, business owners, people who did all of their homework on every other financial decision in their life, sign paperwork for a product they didn't fully understand, which was sold to them by someone who called themselves a planner, but was in that specific meeting just a salesperson. And I've watched it cost them anywhere between $150,000 to over $400,000 in fees and lost growth over the course of a retirement. Here's what I'm going to do in this video. I'm going to show you exactly how the product versus plan confusion happens, 3 specific phrases that signal you're in a sales meeting disguised as a planning meeting, and I'm going to walk you through the actual math of what a variable annuity or annuities in general cost you when they have a living benefit rider attached on a $3 million household over 20 years, compared to what real planning actually costs with real numbers on both sides. And if you're watching this thinking, wait, I already own one of these vehicles, stay with me. I'll tell you at the end exactly how to evaluate whether the one you own is helping you or hurting you, and what your options are if the answer is the second one. You're not stuck, but you need to know what you're actually looking at first. And before we jump into the actual video, I want to say something that might be a little controversial. Annuities aren't bad. They are actually a really great tool for specific investors. But when it comes to somebody who has $2 or $3 or maybe even $5 million saved, the bulk of which is in retirement accounts, they're typically not necessary, because those investments typically solve an income problem that those investors don't have. I'm Ryan Knoll, founder of Nav Wealth. Before we get into it, there's 2 things you should know that change how you hear the rest of this video. First, our firm is in the annuity business, but just a little bit. Less than 3% of our revenue involves any insurance products at all, and only when it's specifically the right tool for a specific situation. So I don't have an incentive to sell you an annuity. I don't have an incentive to talk you out of one either. Many of our clients had annuities from previous advisors, and to simplify the process of working with us, we hold them here. We've actually sold 1 annuity since Nav Wealth's been opened. And second, our fee is roughly 1% of assets and tiers down at higher balances. That's the standard for fiduciary advisors serving this range. I'm telling you that up front because later in this video, I'm going to show you the actual cost of a variable annuity, and I want you to have that number in your head when you see the annuity fees. I'm not going to pretend real planning is free, because it isn't. But the difference between what it costs and what an annuity costs is the entire point. So let's jump into it. Here's the confusion at the center of everything. A plan and a product are 2 different categories of things. A plan is coordination, it's strategy across your entire financial life. Your taxes, your income timing, your asset location, how you pull money out, which we call your withdrawal sequence, and your estate. A plan gets updated every year because your life changes every year. We don't know what's going to happen to the tax code. We don't know what's going to happen with cost of living adjustments, which is why we need to revisit every year. It's a service someone provides you continuously. A product is a single financial instrument that does one specific thing and is typically one singular transaction. A mutual fund's a product. A CD is a product. And yes, an annuity is a product. Products don't coordinate anything. They deliver one specific cash flow characteristic in exchange for one specific cost. I often say planning is the vehicle in your road trip. It's the car you're all getting into. But what makes that car go is the different investments inside of it. Somebody's the driver. Somebody's the passenger. You might have your great aunt Cheryl sit in the back as the backseat driver. But those are just the products that make you go in this instance. That's what an annuity is. That's what a CD is. That's what any financial product is. But realistically, you need both. Every $2 to $5 million retirement uses products inside of a plan. That's not the problem. The problem is when a product gets sold to you as the plan. When someone says, with this annuity, you don't need to worry about the market because you will never go down with it, or you have guaranteed income for life that you can't outlive. What they're describing isn't a plan. It's a product doing something, and it's replacing the coordinated strategy you actually needed with a single instrument that doesn't touch 90% of what a real-world plan would touch. A variable annuity with a living benefit rider doesn't do your Roth conversion strategy. In fact, it probably hampers it. It doesn't harvest your capital gains at the 0% rate. It doesn't manage your IRMAA thresholds. It doesn't handle the ACA subsidy cliff for early retirees. And it doesn't optimize your asset location. It doesn't sequence your withdrawals. It doesn't plan for your surviving spouse's bracket compression. In fact, it makes it worse. It does one thing. It pays you a guaranteed income stream for life, sometimes under specific conditions with significant fees. That one thing has legitimate uses in specific situations, but it's not a plan. And when it gets sold to you as the one thing that is a plan, everything else in your financial life stops getting coordinated. And that's where you lose, because the salesperson who sold it to you isn't a planner and won't be doing the coordination for you. That's the setup. Now let me tell you exactly how the actual sale happens. I call these the 3 triggers. If you're sitting in a meeting and you hear any one of them, you're not in a planning meeting anymore. You're in a sales meeting. The person across from you may not even realize the shift happened. They may believe they're helping you, but the language they're using is sales language. So let's go to the trigger phrases now. And the first one is market upside with no downside. This phrase is the single most common one, and it's mathematically impossible in the form it's presented. What the salesperson is usually describing is a fixed index annuity or a variable annuity with some sort of floor or cap or buffer. What they're not describing is the cap or the participation rate or the spread, or the fact that upside is measured on price return, not total return, so the dividends typically don't count, which are roughly 30 to 40% of long-term equity returns, and they're excluded entirely. If I took the S&P 500 dividend out for the last 30 years, you would have a vastly different picture in your investment account than you do now. So when you hear market upside with no downside, what's actually being sold is capped upside, a participation rate under 100%, no dividend inclusion, and a floor that only protects principal, not principal minus fees, not principal adjusted for inflation, just nominal principal from point A to point B. The gap between market upside and what you actually get is often 4 to 6 percentage points a year in return. Over 20 years, that gap alone, before any other fees, is the difference between your $1 million growing to $3.2 million and $1 million growing to 1.6, so half the amount. Just think about that the next time you hear that phrase. Now let's move on to the second trigger phrase, which is guaranteed income for life. And this one's technically true, but it's profoundly misleading at the same time. Yes, the living benefit will pay you an income stream for the rest of your life. The guarantee is real. What's also real, though, is you're paying somewhere between 1 to 1.5% every single year just for that guarantee, on top of the mortality expense charge, sometimes listed as the M&E expense, which is normally around another 1 to 1.5% on top of sub-account fees, which are another 0.8 to 1.2%. So the guarantee here is costing you 2.8 to 4.2% of your investment amount every single year. And here's what nobody tells you. On a $500,000 annuity with a guaranteed living withdrawal benefit rider paying you something like $25,000, $30,000 a year of guaranteed income, you could take that same $500,000 and put it inside of a diversified portfolio within a real planning relationship. And you won't generate the amount of income annually, probably somewhere in the ballpark of $20,000 to $22,000 a year if we're using safe withdrawal rates as a guideline. But you're going to have far more flexibility, you're going to have better tax treatment, and you're going to get a step up in basis for your heirs when you pass away. You don't get any of that with the annuities. So the guarantee is buying you an extra $3,000 to $5,000 a year of income. In exchange for that extra income, you're paying roughly $12,000 more per year in fees than you would in a coordinated plan doing the same job. That trade only makes sense if you're going to live an unusually long time, and markets underperform for your entire retirement, and you can't tolerate any income fluctuation. Otherwise, you're paying $12,000 a year to get $4,000 a year back. and giving up flexibility, tax control, and estate value in the process. Now let's go into the final trigger phase 3. Your money can't lose. The specific word lose is doing enormous work here. It usually means your nominal principal is protected from market drops. It does not mean your purchasing power is protected. It does not mean your account grows fast enough to keep up with inflation. It does not mean the fees don't erode the principal over time. It does not mean your beneficiary receives what you invested. In real terms adjusted for inflation and net of fees, your money absolutely loses. And in most low return market environments, it does. This happens a lot with fixed index annuities especially. The salesperson says you can't lose money, but then we have a year like we had in 2022 when both stocks and bonds were down double digits. And while you don't feel the pullback, the account fees still drag your portfolio value down on the portion of your funds that was never supposed to lose anything at all. So 3 phrases, if you hear any one of them, take the packet home and don't sign anything. Review it and make a decision with a clear mind. Now, I want to be honest with you about something because I've been circling around it for the last 6 to 8 minutes here, and I owe it to you just to say it directly. I get frustrated by this, genuinely frustrated. And the reason I get frustrated isn't because I think annuities are evil or because I think that all people selling them are all bad people. Most of them aren't. Most of them have been trained on a sales system, given quotas, and told the products they sell are good for retirees. And in some cases they are, in many cases though they're not. But they believe it. What frustrates me is watching what happens when a $3 million household, someone who saved and worked hard for 30, 40 years, someone who did the hard part, walks into a meeting expecting a plan and walks out with just another product that they don't really need. And that product costs them something like $200,000, $300,000, $400,000 a year over their retirement in fees that they didn't fully understand when they signed. And when they come to my office years later and I run the math and show them what it's actually costing, the same reaction happens almost every time. It's not anger, it's grief, because they realize they trusted the wrong person at the wrong moment, and it's affecting what they can leave to their kids. I've had this conversation more than 100 times in my career. Every single one is the same, and every single time the person sitting across from me feels stupid, which is the infuriating part because they're not. They've accumulated levels of wealth that most people dream of. They're honest people who assume that the person calling themselves a planner was actually a planner. That's not a failure of intelligence. That's a failure of the industry that we work in to distinguish between roles clearly enough. And that's a problem for another video that we'll cover. If any part of this is resonating with you, if you've had this meeting or you're about to have it, or you already own one of these products and something in your gut is telling you to look closer, that's a review my team will do for you for free. We'll take 30 minutes to review your policy with you so you understand it. There's no pitch, there's no sale. We just want to make sure you know what you own. You'll leave with a written analysis of whether this makes sense for you or not. The link's in the description. Now let me show you the numbers. Let me walk you through what a variable annuity with a guaranteed lifetime withdrawal benefit rider costs a $3 million retiree. Because the honest comparison isn't an annuity versus zero. It's an annuity versus a different alternative. So here's the scenario. $500,000 of a $3 million portfolio placed into a variable annuity at age 62. And if you ever meet with somebody who says that all $3 million needs to go into an annuity, run for the hills. They're definitely a salesperson. So let's just assume that this annuity you're buying has standard sub-accounts. It's a standard rider, and it's held for 20 years until age 82. The fee stack on the annuity is this. There's a mortality and expense charge, that M&E fee, something like 1.25% per year. That's the base cost of the annuity wrapper itself. Then there's the sub-account fees. Those typically range from 0.6 to, I've seen them as high as 1.5%. But let's just say they're 0.95% per year on average. These are the mutual fund-like investments inside the annuity. In a regular brokerage account, similar funds cost 5 basis points to 20 basis points, so 0.05 to 0.2%, so a fraction of the sub-account fees inside the annuity itself. Inside an annuity, you're paying 5 to 15 times that. Rider fee for the withdrawal benefit might be somewhere around 1 to 1.5%. Let's just call it 1.2 to meet it right in the middle. And that's an annual fee on the benefit base, which grows separately from your account value. So this fee compounds against a rising number. So the total annual cost of this annuity is roughly 3.4% of the account value every single year. On a $500,000 balance, that's $17,000 a year in year 1. By year 10, often $22,000 to $25,000, and by year 20, it could be $30,000 or more on the same original investment. Now, the honest comparison here, what does a comprehensive fee-only planning relationship cost at this asset level? Industry standard AUM fees at $2 to $5 million run about 1% a year. In full transparency, here at NAV Wealth, the same client would pay roughly 0.8% on all $3 million invested. Add another 10 basis points for fund fees, and you're paying in the ballpark of 0.9%, just to give you a sake of comparison. And yes, I know a lot of you will leave comments saying that even that is high, but those are the same people who book a call with our team expecting our advice to be free. Real planning costs money, and the integration of every moving part more than covers that fee. But here's the difference from that integration. For that 0.9%, the household gets Roth conversion coordination, capital gains harvesting at 0%, asset location optimization, IRMAA management, withdrawal sequencing, making sure if you're retiring early, you're not going to hit the ACA subsidy cliff, and estate coordination, a complete plan that's updated every year for tax law changes and cost of living adjustments for the rest of your life. For the 3.4% inside the annuity, they get a guaranteed income stream that might not even keep up with inflation. One product, one feature, none of the coordination, and it's likely causing them a tax nightmare that was never disclosed at the beginning of the relationship. The annual cost gap is 2.3 percentage points on a $500,000 balance. That's roughly $11,500 more in year 1. Growing as the account grows over 20 years, that gap compounds to roughly $250,000 to $300,000 in additional fees paid to the insurance company versus what that same money would have cost inside of a comprehensive plan. And that $250,000 to $300,000 gap is buying nothing. It's not paying for tax planning. It's not paying for Roth coordination. It's not paying for anything the annuity isn't already delivering. It's just a pure cost on top of the cost you would have paid for a real plan anyways. That's what we call the fee iceberg. It's not that annuities are expensive relative to zero. It's that they're expensive relative to what a real alternative costs to deliver a real service. And the difference is buying nothing. I told you at the start I wasn't here to argue that annuities are evil. I want to make good on that because there are legitimate use cases and I want to be precise about them. So here's the first one: longevity insurance for households without pension income. If you're single, you have no defined benefit pension, your Social Security is modest, and you're genuinely worried about outliving your money past age 90, a single premium immediate annuity, also known as a SPIA, or a deferred income annuity, at age 80 can make real sense. These products are simple. You give the insurance company a lump sum. They pay you a fixed income for life. There's no living benefit rider, no sub-account fees, no complexity. The fee is embedded in the payout rate. You can compare it to what you'd earn in a bond portfolio and decide honestly. And if there's money left over, meaning you didn't spend everything you gave the insurance company, make sure that you have a return of premium on there that says you can have your funds paid out to your beneficiary for any unused portion. So if you put in $1 million, only use $800,000, there's $200,000 left, that would go to your beneficiaries. Legitimate use case number 2, a multi-year guaranteed annuity, also known as a MYGA, as a CD alternative. MYGAs pay a fixed interest rate for a fixed term. They're tax deferred. In specific rate environments, they can beat a CD of the same duration by 50 to 100 basis points. That's 0.5% to 1% for those of you who don't know what that means. If you're going to hold cash equivalent money for 5 years and you don't need it before then, this can be a rational choice. It's not a plan. It's a product used correctly inside of a plan. If you're just rate shopping, they typically offer really good rates if you can leave them invested for 3 to 5 years or more. Now, legitimate use case number 3, you need a guaranteed income floor for a very specific psychological need. Some people, regardless of what the math is, can't emotionally handle watching their portfolio fluctuate in retirement. And I get that. Sometimes being able to sleep at night is worth more than the extra dollar of return. For that person, having some portion, let's say 20 to 30% of their assets producing guaranteed income, can be the difference between staying invested in their remaining portfolio during a downturn versus panic selling at the bottom. In that specific use case, the fee of the annuity is really the cost of avoiding a much worse behavioral mistake. So notice what none of these three use cases involve. None of them involve a variable annuity with a living benefit rider on a $2 to $5 million portfolio held by someone with pension income, a spouse who also has Social Security or pension of their own, and a taxable brokerage account. That specific combination, the one being sold most aggressively to $2 to $5 million households right now, is the one that almost never has a defensible case at that asset level. I also want to leave you with one more legitimate use case here. You actually need guaranteed income because your assets don't produce enough without it. If you're staring down the barrel of retirement, whether you have to quit because you were laid off or health concerns or what have you, and you're unsure if your assets will provide you with as much income as you need, an annuity could be an option. On a $1 million portfolio, you could withdraw around $40,000 to $50,000 annually before the withdrawal might become too large to sustain and expose you to what we call sequence of returns risk, or the fact that compounding a down year with a large withdrawal will not allow you to have a portfolio that can recover from that. So if you need something like $60,000 a year to live on, that could be an issue. However, let's say you could put half of your money in an annuity that pays 6 to 7% annually for life and leave the other half in the market. You can get somewhere between $50,000 to $60,000 of income. That either narrows your gap or it closes it completely. So this is a good use case for an annuity for those of you who are retiring and not prepared for the next step. Now, the section I promised you at the start is if you already own a variable annuity with a living benefit rider, here's how to evaluate what you have and what your options are. Step one is to pull the actual documents, not the summary the salesperson gave you or the illustration they handed you. You want the prospectus and the current statement. You want to find three specific numbers: your current account value, your current benefit base, and your surrender charge schedule. Step two is you want to calculate your all-in annual cost. Add the M&E fee, the sub-account fees, the rider fee. If that number is above 3%, you own an expensive one. If it's above 3.5%, it's a very expensive one. And it's important because the cost of some of these fees might be on the actual dollars invested. Others might be on the benefit base. And this is why it's important to start with the prospectus, because then you can understand not only what each of your account values are, your benefit bases are, but also what they're charged based off of what the prospectus says. So typically what we find, a 1% fee on the account value for M&E doesn't end up being as expensive as a 1% fee on the benefit base, which is designed to go up at a higher rate every year. So just make sure you understand what the crediting looks like and then how those fees are charged to that crediting structure. Step three is you want to check where you are in the surrender schedule. Most variable annuities have a surrender charge that starts at 7 to 8% in year one and steps down by about 1% each year until you're able to fully liquidate it. If you're past the surrender period, you can move the money without penalty. If you're inside of it though, that math changes and you just want to make sure you're more than breaking even should you break that contract early. Step four, you want to run the hold versus 1035 exchange versus surrender math. A 1035 exchange lets you move the money to a lower cost annuity without triggering tax. So it's a move where you can go from one annuity directly to another and you don't pay taxes on the gain. So if you put $100,000 in, it's worth $150,000 now. You don't have to liquidate it and then move it, triggering a tax charge on that $50,000 gain. You simply move it from A to B, bypassing that. It works similarly to how you would roll over a 401k to an IRA. Then next, you want to understand what surrender means. And surrender means taking money out entirely and paying tax on the gains. The right answer depends on your specific numbers and your specific product in your specific situation. And a quick note on the gains. They're taxed as ordinary income, not as capital gains. So be sure you're minding the higher tax rate these vehicles produce. $50,000 in a stock held long term is typically taxed at 15 to 20% in most cases. For that same investor in ordinary income tax land, that's likely 22% or higher. So there's going to be a delta there from the tax advantage you get from the traditional investment route versus the annuity route. Now, with all that said, some annuities are worth keeping, some are worth exchanging, and some are worth surrendering. The honest answer is it depends, and it takes 30 to 45 minutes with someone who has no incentive to sell you a replacement product to figure out which one you're in. You're not stuck, you're not trapped forever, but you do need someone who's going to run the actual math on your actual product without trying to sell you the next one. So here's the takeaway. Product and plan are not the same thing. A variable annuity with a guaranteed lifetime withdrawal benefit rider is a product, not a plan. It has legitimate uses in specific situations. It's not always a bad deal. It is almost never the right primary vehicle, though, for someone with $2 to $5 million saved. And when it's sold to you as the only plan or as the major component of a plan, everything else in your financial life stops getting coordinated because the person who sold it to you is a salesperson, not a planner, regardless of what their business card says. If you're considering one right now, take the packet home, don't sign, get a second opinion from someone who has no incentive to sell you a replacement. If you already own one, pull the documents and run the math we just talked about a few minutes ago. Know what you have before you decide what you need to do with it. And if you want our team to run that math for you, either the am I about to buy the wrong thing question or the what do I do with the one I already own question, the booking link is in the description. We'll give you 30 minutes and a written analysis that's yours to keep, whether you work with us or not, because you saved for 40 years to build a $2 to $5 million portfolio. That deserves a plan, not a product wearing a plan's clothes. I'll see you in the next video.